Today we'll be discussing student loan repayment. The MidFirst Bank Money Coach program is a collaboration between MidFirst Bank and the University of Oklahoma to provide financial education to all OU students. We want you to be successful after you graduate from OU. The best way to be successful at repaying your student loans is to create a student loan repayment plan. The first step to creating this plan is to compile a list of all the student loans you have obtained. First, let's discuss the different types of student loans that you may have. You may have borrowed money from the federal government in the form of a federal direct loan. Your parents may have taken out a Parent Plus loan from the federal government. If you took out a federal direct loan, then you will need to contact your loan servicer. A student loan servicer manages the student loan, including payment plans, updating personal information, tracking payments, assessing interest and fees, and more. Think of a loan servicer as a middleman between you and the federal government. To identify your federal loan servicer, go to the Student Aid's website at www.studentaid.gov. Your parents will have their own loan servicer for their Parent Plus loan. You may have borrowed money from OU. If you have questions about your OU institutional loan, contact the Office of Student Loan Services in Buchanan Hall. You will repay OU directly, so stay in contact with the Office of Student Loan Services. Some students borrowed money from private financial institutions. If you borrowed money from a private financial institution, then you need to contact your lender for repayment information. A lender is an organization or person that lends money. If you are unsure if you have a private student loan, pull your free credit report from all 3 credit reporting agencies at www.annualcreditreport.com. Your loan servicer or lender will help you answer the essential questions like, what is my total loan balance? What is my interest rate? What is my monthly payment? When is my first payment due? And what is my repayment plan? Stay in contact with them and make sure to keep your information updated. If you change your phone number or move, then you need to notify them. Now that you know which student loans you have in your name and who to pay, you need to know when you were required to pay back your loans. After you graduate, some of your student loans will have a grace period before you are required to begin making payments. A grace period is a set length of time after the due date during which payment may be made without penalty. For example, you have 6 months after you graduate to begin making payments for federal direct loans. However, your Parents Plus loan does not have a grace period. Federal Perkins loans have a 9-month grace period, and OU loans have a 6-month grace period. Private student loan grace periods vary with each financial institution, so contact them directly to determine if you have a grace period. There are 2 types of repayment options: non-income driven plans and income-driven plans. The non-income driven plans are designed to pay the student loan off in full over a set period of time. These plans are based on loan debt. Income-driven plans are based upon income and family size. They must be recertified annually or the plan defaults. If a student has the ability to pay their student loans in full, this option would be most beneficial because it will save them money in the long run by avoiding interest. Most students do not have that ability, so the standard repayment plan is the best plan to minimize interest payments. A standard repayment plan is designed to pay in full the balance of the student loan in 10 years with 120 equal monthly payments. All federal loans are defaulted to this plan. In this example, a student that borrowed $15,000 in federal loans will pay over $20,000 by the time they pay off the loan in 10 years due to paying back the principal plus interest. A borrower can accelerate repayment by increasing monthly payments whenever they can afford to do so, which will save the borrower more money as they pay less in interest. A standard repayment plan has a fixed monthly payment and does not change. Monthly payments increase over time with a graduated repayment plan. The graduated repayment plan acknowledges that a borrower generally earns more money as they gain experience after working for a few years. Therefore, the plan starts out with a low monthly payment, which usually only covers the interest, and every 2 years the payment increases. Eventually, the monthly payment will be higher than the standard repayment because the loan must be paid off within 10 years. The graduated repayment plan will cost the borrower more money in interest over the 10-year period than the standard repayment plan. Students who do not qualify for an income-driven plan but borrowed more money than $30,000 in federal loans may qualify for the extended repayment plan. The extended repayment offers the lowest monthly payments of all the non-income driven plans. The more affordable monthly payment is a direct result of the longer repayment term, which increases the total payments over the life of the loan. But this plan will cost the borrower more money in interest. In this example, the borrower will pay over $12,000 more in interest for the extended repayment plan. In order to qualify for the income-based repayment plan, the borrower's income must be low compared to the eligible student loan debt. The loan servicer is looking at your debt-to-income ratio. Monthly payments tend to be lower with income-driven plans than non-income-driven plans. Instead of paying the loan off in 10 years, the payments will stretch across 20 or 25 years, depending on which plan for which you qualify. Once you make consistent payments for 20 or 25 years, your remaining student loan balance is forgiven. However, the loans that are forgiven is taxable income. Here are some things you need to know about the income-driven plans. The borrower cannot choose the income-driven plan for which they qualify. Income and family size impacts eligibility and payment amount. The plan must be recertified annually. To learn more about income-based repayment plans, go to the Student Aid's website, which is studentaid.gov. It is important to pay back your student loans on time so that it doesn't affect your credit score. Late or missed payments stay on your credit report for 7 years, which could possibly hurt your ability to borrow money in the future, gain employment, rent property, or open utilities in your name. Congratulations on reaching your goal of graduating with your degree. If you would like to create a personalized repayment plan before you graduate, contact a money coach. You can make an appointment with your money coach in iAdvise. If you do not know who your money coach is, please email us at moneycoach@ou.edu. Don't forget to follow us on social media. If you would like to learn more about personal finance, check out our online tutorials. Thank you for joining me today and going over student loan repayments.